And good evening, everybody. Welcome to Tuesday Night Q&A, Moffat on Money. Now, I'm Clay, joined by the lovely and gracious E-Train, who had a little bit of a medical emergency. She had to play nurse for the chunk.
I did.
He apparently ripped a nail and was bleeding somewhat excessively.
He was. We got some bleed stop, and we are good to go.
Did you get it stopped?
Excuse me, it just took a sec. Not sure. He is on the patio right now, and we'll find out. Or I won't find out. Someone will find out and figure it out. I have delegated that elsewhere at this point.
Fair enough. Well, I hope the little booger's okay. He is.
Me too.
He is cute as hell.
He is.
He's a sweetie.
And sweet. Mm-hmm.
Hope it's been a good week for everybody. It's been a little bit somewhat unusual for me today. I was going to give a test. I teach a Bitcoin and blockchain class. And I was going to give a test in there today.
Mm-hmm.
And as I was handing it out, I realized that the answer key had been copied with the exam.
Moffat.
So I had to
We've talked about this.
Back up pretty quick.
Chunk was bleeding, Melissa. He's okay.
Yeah. He caught a toenail on something and cracked it. And so those little boogers will bleed profusely, as you probably are aware. So
Moffat had
to get him stopped.
Yeah, Moffat had an issue with answers on a previous exam for another class.
I've actually had 2 different issues in my years.
Besides this?
Are you talking about the Instagram one?
That's the one I'm talking about, yeah.
Okay. Green Bean heard the news and he started barking. Empathy pains.
Mm-hmm.
Tell Green Bean Chunk is going to be okay.
Yes, because Chunk is not feeling any pain. I just noticed there was blood everywhere. And I'm like, what is going on?
Yeah, he's still focused on trying to get the ball.
Yes, I had to take the ball away.
I've never seen a dog so intensely focused on a ball ever in my life. I've had dogs that love balls, love chasing the ball, but they would wear out. Chunk never wears out, never gets tired of it. The ball is like his constant companion. It's his
whoopee.
It's his whoopee. It's his soulmate, whatever.
Mm-hmm.
Yeah. He never wants to be without it. He'll carry it around everywhere.
And have no idea why it is such a big thing for him. Like
it is. It's incredible. I've never seen a dog like it. And he's not even a retriever. But he loves it.
He's a terrier.
Yeah. A little dinky ass one too.
Mm-hmm.
But we buy these real soft balls. And he's able to bite them and squeeze them. And, as far as his head, the ball's like this big compared to his head. And he'll be carrying that ball everywhere he goes. It's pure gold to see. And they're bright fluorescent colors. And of course, he's black, solid black. So at night, all you see is this fluorescent ball floating through the hallways or whatever.
The ether.
The ether.
Yeah, they're bright green, pink, or orange.
Yeah, they are literally glow in the dark. They're bright. Mm-hmm. The Instagram test issue Ellen is talking about is I also teach a fixed income derivatives course, and it's a modestly challenging course, I will admit. I've got a student who now runs his own private equity firm. So a relatively accomplished student. And I was his only B. And every time I see him, he reminds me that I'm the only one to ever give him a B. And it was in the fixed income derivatives course. But the real funny thing is, in his class, there was a young lady. I'm just going to call her Danielle. Sweet girl, love her. And she bright girl. At fixed income derivatives, it's an elective. I don't get a whole lot of students clamoring to take it. But she was in there, and she is one of only 2 people to ever earn an A in the course. And after the final, she came up to me. She did relatively well on the final. And she was laughing in good spirits, of course. And she told me her secret. She had found my Instagram page. And on it, down through the years, I'll have students who, I've been teaching the course for several years. I have students who haven't been able to really answer questions. And so they'll write something down like, I have no idea how to answer the question, but your hair looks really good today, Dr. Moffitt. And they make me, smile. And so I would post some of them on my Instagram down through the years. And so she was going through my whole Instagram and she saw these questions. And so she started writing them down, finding the answers. And, like half of them were on the final. So that was her big advantage.
Yes. God bless her. She's smart to figure that out, though.
She is. It made me laugh. Still kind of pisses me off and still makes me smile at the same time. So, Danielle, if you're out there watching, I will tell that story for the rest of my life.
Hey, Moffitt, put the clip down.
Oh, can you hear it?
Yeah.
All right, I'll go. Sorry about that. I'll go back to the pen.
No, not that either.
It helps if I have something to fiddle with in my hands, because still talking on a computer is weird to me. Talking at a screen or whatever. I'm used to having people in the room and walking around and moving. So sitting in one place,
can I get you something that doesn't make any noise?
Is awkward. I don't know what that would be. Maybe one of Chunk's balls.
No, those are squeaky. You need to find like a stuffed animal to play with. No.
I'll work on it.
Okay.
Silly putty.
You need some silly putty.
That used to be the coolest stuff.
I remember if you do it the right way.
Yeah, I remember we used to have newspapers with colored cartoons, and you could flatten out the silly putty and put it on the cartoon and peel it off, and it would have the cartoon image on it. It was kind of cool.
All right.
Back in the day, we found simple entertainment. Yeah.
Us Gen Xers did that too.
Again, taught and led by the boomers.
Uh-huh.
Where would y'all be without the boomers?
A little less tortured, but not nearly as strong.
We're actually going to talk about that a little bit tonight, maybe.
Are we? Okay.
Speaking of tonight, got a question. Wanted some additional detail or explanation on manufacturing and tariffs. So we're going to take a look at that. We're going to look at some of the specific state impacts and get into some of the more specific effects, or what I see as possibly the more specific effects. So stay tuned, have some fun, join in. If you've got questions along the way, E-Train is monitoring all the stations, and it's a good night to ask questions. So just type them in and she will relay them if you're on Rumble. X, I'm still not certain if we get questions directly from X.
Well, you know what? I know how to find out.
But if you are, if you're on X, on YouTube, you're fine. We get those fed in directly. Hey there.
Yep.
I think that works.
That's me.
So, all righty. Well, let's get the show started. As I mentioned, we're going to cover or discuss manufacturing. looking at it on a national picture, this graph shows the amount of particularly motor vehicles and parts, which is a big area. Which, today's just not my day because
What is
this is the wrong graph.
I'm like, what are you talking about? This makes no sense.
I just sit there and looked at the title of it and I'm like, where the hell did that come from? So anyway.
I'm sure there's a great graph for that somewhere.
Somewhere. This one still kind of applies because it's a big impact on national manufacturing jobs. But it's not exactly the information I'm talking about here.
Okie dokie.
Yeah, I know. This
you
is
do you,
this is
boo.
just not my day.
I did actually text you. Want me to send you that thing I sent you earlier?
Yeah,
Email
email
it
it to me. I meant to get that, but it was on my
Okay.
text and not my email. And keep in mind, I get home at 3:30 or 4, try to fix up a quick dinner, and then I start working on this. So some of it's a little bit last minute, a little hectic. But that's not what I wanted. So, bottom line, national manufacturing jobs have dropped post-COVID. We had a bit of recovery from COVID, but most of the jobs peaked somewhere around 22, 23. And since then, they've been relatively steadily declining. And part of the problem was most, like during the lockdown period in the COVID era, the blue states who were heavier in the manufacturing base maintained the lockdowns longer. So that hurt the ability of plants to open back up after COVID and rehire workers. Now you can see even in this graph, as the lockdown started ending in mid-21, it took 3 years to regain the jobs lost to the pandemic. And they barely...
Just because I can't see the dates. Maybe it's just my screen. What are we looking at?
This is 21.
Okay.
This is July of 23.
Okay.
And this is February of 25.
Okay. And I have sent
that help
to you. Yeah, and I sent that picture to you, so that graphic.
Yeah. Let me dig that out real quick. Anyway, we're down. The manufacturing jobs have been in steady decline over the past year. In fact, we lost about 45,000 manufacturing jobs the last 3 months of 2024. Now, okay, that's China. Let me save that. Save as a picture. Find the right file.
We are professionals. WAP.
I prefer to think of it as we're flexible. We adapt.
We are.
Improvise and overcome.
Yes. Let me put some information in there for you. Almost all of the manufacturing jobs. Are you going to go into this, the China thing?
Yes.
Since 2000. Okay. I will let it be. But we have the right graphs.
All right. So, the last quarter of 2024, the nation lost around 45,000 manufacturing jobs. Pretty solid loss. In February, if you'll notice the tail end of the graph, now this is only in automobiles and durable goods, it was up. Manufacturing overall increased 10,000 jobs in February. So kind of a nice little turnaround from the previous 3 months.
Of this year?
Of this year. I mean, of last year, end of 2024. From September through December.
No, I meant February. They were up 10,000 this year or last year?
This year.
Okay. You're like, yes, both. Okay. Got it.
All right. Let me try this again. Last quarter of 24, down 45,000. February, up 10,000.
Of
Better?
this year.
Yes.
Year. Okay, thank
2025.
you. Thank you. We're gonna
She
figure this
keeps
out
me honest.
eventually, y'all. Mm,
Um, that's all right. If she irritates me too much, I'll go flunk somebody tomorrow. Kind of even it out.
there you go. Mhm.
I love my job. Have I mentioned that, by the way? I have a great job. Anyway,
Yes, you do have a great job.
looking at some of the individual impacts on the states, individual states, I took 5 of the largest manufacturing states. In Michigan, for example, this is actually the right graph. Yay me. The
Yay.
last quarter
Now, what
of
timeline is this, though?
this goes for since COVID. So since the 1st of 21 through February.
Okay. Okay.
So the last quarter of 24, jobs were down 9,000, a little over 9,000, 9,100. The state has lost nearly 30,000 jobs since September. Okay. And the state lost, 1,000 jobs last month. So Michigan. If we look at Illinois, another heavy manufacturing state, down about 4,500 the last quarter and decreased, I think it was 500, 600 in February. So still decreasing. California's been hammered pretty good. It lost 11,000 jobs the last quarter. It's lost 70,000 jobs since the peak in 2022, and that's just post-COVID. You had the lockdowns ended, so you had some recovery in jobs. And then from that peak in July of 22, it's been downhill every month, almost every month, consistently. Not a good result in California. And then we've got Ohio. Ohio's been a little flat, a little bit more consistent. It was up 2,000 the last 3 months, but down 5,500 from its peak in July of 23. So here's June, July of 23, right in here. Texas has been kind of the outlier. You've had a lot of companies moving to Texas over the past 4 or 5 years, and it's reflected in their, manufacturing gains. It lost 1,900 jobs the last 3 months of the quarter. It gained a few in February. But over the last 2 years, it's gained almost 49,000 jobs. So
Nice.
pretty strong performance for Texas. And that's that's kind of the result of low taxes. It is attractive to workers and employers. So we get a picture of manufacturing slowly ebbing away in most states, manufacturing ebbing in the country. Now, manufacturing is important to the economy traditionally, and I would argue even currently, because it offers opportunities to non-college educated people, non-college graduates, which there are decreasing good opportunities for non-college graduates. And even college graduates who graduate, let me just say, with a non-STEM degree, have trouble finding good jobs. If you graduate in poli-sci, history, psychology, gender studies, honestly, where are you going to use a gender studies degree? You just go down the road and look at and get a job at the gender studies factory? I really don't know what you expect to do with that degree as an undergraduate. No idea. Or some of these more modern degrees that people get, and you come out of college $50,000 or $100,000 in debt. You've got a mortgage already that you cannot afford to pay with whatever job you get at Starbucks. So, that's bothersome to me. I think those of us, in the university system are screwing some of these kids without allowing them to make informed consent on the majors they're choosing. We just let them choose whatever they want, whatever sounds, curious to them at the time, regardless of their ability to get a job with it afterwards. So manufacturing is important because it allows people who don't have a college degree to get relatively high wages with very strong benefits, pensions, health care. It's also relatively stable historically. That's a big consideration. But as Ellen was alluding to a few minutes ago, that changed around 2001 when China joined the World Trade Organization, the WTO. The manufacturing industry, one of their affiliates, EPI, estimates. Do what?
I was just going to say it might be a good time to put that other picture up. I'm just saying.
What E-Train wants, E-Train gets.
I would just show the first half of it before you do the second.
That's all I got. And I'm not really sure what I'm looking at here.
No, just blow it up.
Okay, this is 2000. And it shows.
They can't see that. It's too small.
Is that what you meant?
Just show that first half. There you go.
Okay. Yeah, I didn't understand the first half. This is in 2000. This shows China with 6% of the pie, the manufacturing pie. U.S. had 25%, Japan 11, and so on. Then you go down to the bottom half, 2030 projection.
The 2030 projection. This is
China with
after China joins the WTO.
Yeah. 2000 was right before. And it shows the U.S. percentage of manufacturing dropping to 11%. Now, I'm not sure you've got the low and middle income. I'm not sure what these two pieces of the pie are indicating. That probably was in the story that I did not read or get. So not sure what exactly some of this is saying. Most of these are countries on this side. But the big picture is that China is the manufacturing powerhouse. In fact, it's gotten so bad that we don't manufacture antibiotics in this country. If China wanted to cut us off from antibiotics, we'd have no source. That's pretty severe. It would take 6 months or a year for us to start producing enough to cover the demand. We could do it, but we'd lose production of other important, maybe not as essential drugs. But that's not altogether a significant or insignificant strategic concern, is the ability to produce essential goods and services at home. Now, as I said, that the EPI estimates that the U.S. has lost about 2.1 million jobs to China. And this is just in the period from 2001 through 2011. 2001 to 2011. That's this dump you see here from the red arrow down to the bottom. 2.1 million jobs lost. So that's That's pretty damn significant, particularly when you're talking about a chunk of the middle class available jobs, lower class available jobs. Now, manufacturing jobs are still trending downwards. Never reached, as you can see, never got close to the pre-2008 level, which is right here before this gray region. This is the 2008 subprime crisis, the recession. So, as you can tell, manufacturing jobs have never even gotten back to the 2008 level. We continued losing jobs. There was, a slow but steady gain under Obama. But if you'll notice, the slope kind of changed in 2017, 2018, 2019. It got steeper. That means we were adding manufacturing jobs faster. The significance of that is this was Trump's first term when he was having the first tariff regime. The question I received specifically was, more detail on Trump's tariffs and manufacturing. So, there are all sorts of predictions out there and indications and all. With a lot of them holding that Trump's tariffs will hurt jobs, cause job losses. When, in the manufacturing sector, it seemed to speed up job gains. The trend noticeably accelerated under the first regime of Trump tariffs. That's not an insignificant picture. Now, since Trump has been elected, he announced tariffs against China, Mexico, Canada. He's promising tariffs on all imports. Now, that would be associated with a reduction in the income tax. And like I said, there have been a lot of predictions, a lot of, pain ahead, mostly gloom and doom. And I don't share that necessarily or completely. I have for months, indicated that I think there's some chaos, confusion, or pain ahead. And some predicting all sorts of impact on increasing inflation. That's probably the most common concern you hear. But if you remember in 2017, 2018, 2019, inflation was 1.5%, 2%, 2.25%, somewhere around there. It wasn't bad. Not anywhere near what we've seen for the past 4 or 5 years. So why is that? Because, quote unquote, tariffs do cause prices to increase for the consumers. Well, one big reason is that oftentimes the exporting countries like China will eat the cost of the tariffs. And they do this by effectively lowering their price so that the price post-tariff is unchanged to the American consumer. The way they do this is by devaluing their currency. That's why we didn't see inflation in 2017, 2018, when Trump had his first round of tariffs. So a lot of countries or currencies will drop when Trump announces tariffs. That lowers the effect to the American consumer. Now, it hurts the country that it's coming from because they receive fewer dollars for their goods. And China right now is in a world of hurt. Their economy has just been tanking for a year. They are experiencing a deflationary economy. And they desperately need strong currency. They need money. Now, they've been having to sell treasuries because they need the cash. Not buying treasuries anymore. I've mentioned that fact several times. But they've got people, working for the government, working for cities, working for provinces that aren't getting paid. That's a pretty serious problem. And they cannot afford to lose our business. So, their choices really are receive fewer dollars or receive no dollars. That's the choice. That's not much of a choice. So, I think the effects on inflation will be somewhat muted. And even, the second option is consumers can buy something different. They don't have to buy the imported good if the price goes up. Most of those things are items we can live without. So a lot of times people just forego the purchase. So between those two factors and substituting American made goods, the net effect in terms of inflation, I think will be much more muted than what a lot of people are predicting. And even if spending didn't change, even if the countries didn't devalue their currency, we import, oh, what was it? I want to say 20% of our goods in this country. So if there's a 25% tariff placed on all of those goods, that means the cost of those goods, your inflation goes up 5%. Now, that's not good, but that's a one-time shock, and that's not materially going to impact most people. The trade-off is we'll be seeing and have seen indications of a lot more jobs, good jobs, well-paying jobs coming to the country. And, since Trump was elected in November of 24, it doesn't matter what you think of him personally, but you've kind of got to admit and give him some credit that the results since then have been surprising, and surprising in a good way. In the last 3 months since he's been elected, he's secured more than $2.9 trillion in new investment in the U.S. $2.9 trillion. Now, $1 trillion, we really can't conceive of what $1 trillion is. It is so huge. It just doesn't really relate to the average person. Doesn't relate to most of us. So the best way I can kind of picture that is compare it to what we've done the last year or the last 3 or 4 years. The 2.9 trillion in new investment dwarfs what we had the last 4 years, the commitments of the last 4 years. And in 2023, the total commitment was 43 billion. 43 billion. Trump in 3 months is at 2.9 trillion. Huge difference. That's not bad. Now, if we look at the list, I just took a small handful of the companies that have been announced and listed them for you. But if we just, go through and kind of eyeball the list briefly, you've got, at the top of the list, even though it's not at the top of my list, it's second on my list. Anyway, Apple, dropped a hell of a bombshell last month, 2 months ago, announcing a $500 billion investment in the U.S., in U.S.-based manufacturing. That's $500 billion right there. That dwarfs, that one commitment dwarfs the last 4 years. They're talking about 20,000 new jobs, and that would be 20,000 full-time jobs, 20,000 good, well-paying jobs. Now, in this sector, some of them are going to be for engineers, skilled labor. But most of the manufacturing jobs are repetitive tasks and can be trained. Now, Apple's been kind of shy on the specifics, so we're not exactly sure what they're planning. I mean, will iPhones be rolling off the plant in Texas or chips in Arizona? You don't know the specific plans, but the scale suggests they're pretty damn serious about it. Tariffs on Chinese products are the nudge here, making it cheaper to build stateside than ship the jobs from Beijing, than shipping the products from Beijing. And, most people know, if you've been watching this show, I'm also concerned about the nature of Chinese labor base they use literal slaves. Uyghurs, for example, they force them to take the dangerous jobs, the dangerous mining jobs like mining lithium, mining some of the rare earths, leaves behind uh, radioactive waste. And, obviously these people don't get all the protective gear and whatever else. Um, and I have a problem with that. So I'm glad. And China is not exactly a friend of ours. They've been openly hostile in a lot of areas, particularly in the South, Asian, South Pacific Sea. Militarily, they've been getting more and more aggressive. So that doesn't bother me a bit. I cheer the hell out of that. The next one on my list would be Taiwan Semiconductor, or TSMC, the largest chip making company in the world, one of the most sophisticated, technically advanced chip making companies in the world. That's a big reason why China wants Taiwan. They don't have the technical skills or ability to produce advanced chips. They have to steal them or acquire them other ways. And so they would love to take over TSMC. Well, TSMC has announced they're putting $100 billion into the U.S., building 5 new facilities. That's another 20,000 jobs, And semiconductors are the backbone of everything: your phone, your car, your refrigerator. I mean, I may not be a fan. I want a car without computers. I was talking about that with some friends today. Automobiles are getting so complex that you're getting to the point where you have to take them to a dealer to be repaired. I hate that. My first car was a 71 Challenger, and I could strip that thing down to the block, down to the transmission. I didn't mess with the transmission, but I enjoyed the hell out of that. And if there was a problem, I could generally fix it. And I did a lot of stuff to that car myself. I can't do that now. Hell, I would have a problem even changing the oil. It's getting unreal. You need special equipment to to get to the damn oil filter. So, and all the computer stuff, if your battery dies, you have to go have your car reprogrammed. That's just no. Just hell no. Anyway, it is what it is. So, with this commitment by Apple, with this commitment by TSMC, it could make the U.S. a chip manufacturing powerhouse again. There's some huge strategic implications and advantages to that. Not just the jobs, but a whole lot of other international effects that are good, bode well for the U.S. Then we've got the auto industry, kind of the mainstay of American manufacturing for the past 100 years. Stellantis, the folks behind Jeep and Dodge, made some waves by announcing they're going to reopen their Illinois plant at Belvidere. That's 1,500 to 2,500 jobs back in action, which is pretty damn important for a city the size of Belvidere. They're also have committed to new investments in Detroit, Toledo, and Kokomo. Kokomo. How many of y'all, when I said Kokomo, start singing the Beach Boys song in your head? Melissa, listening while doing your taxes. Here's to a big refund. Amen. I hope you get it. I've still got to do my taxes. I've been kind of dreading it, and I've been so busy. I really haven't had time to do it, but I'm running out of time, so I'm going to have to dedicate a couple days to doing that. Not looking forward to it. And that's another thing. If Trump can, increase tariffs 25% and get rid of the income tax, I'm a fan. I would be a fan. So we'll see. But anyway, tariffs. And there's some other pretty big wins. I've seen where Eli Lilly and J&J committed, billions and billions to opening new pharmaceutical plants in the US. J&J alone committed 55 billion, roughly 10 to 12,000 jobs. Pharmaceutical manufacturing. I don't know exactly what pharmaceuticals, but the more the merrier. Um, that is a massive, massive commitment. Then and there's tons of smaller announcements. I couldn't list them all. GE Aerospace, which is not an insignificant company, but it announced $1 billion for manufacturing upgrades, adding roughly 5,000 jobs to their existing plants. They're going to do more of the manufacturing here. They source parts and components from all over the world. So they're committing to manufacturing more of those parts and components here in the US, probably at about 5,000 jobs, according to their estimate. Uh, you've got a battery manufacturer by the name of Clarios in Wisconsin is expanding with a $6 billion plan. Clarios, whoever thinks about them for batteries, but they're the people who manufacture the batteries that a lot of others will put their sticker on and then sell. I'm not sure all the distributors, but if you go and buy a Walmart battery, it's made by somebody else other than Walmart, probably Clarios. So, but a large battery manufacturer, $6 billion. One of the ones I kind of smiled at was a company called Crazy Art. Crazy Art. It's one of America's largest toy manufacturers, and it's boosting domestic production by 50% and shutting down its Chinese production. I mean, that's going to be hundreds, several hundred, maybe 500 jobs. On the national picture, it's not huge, but you get 100, you get 500, you get 1,000 companies doing that. And remember that graph Ellen sent me where China was 45% of all manufacturing, US was 11? That's how you get that reversed. You create and allow, the private sector to expand and expand rapidly. If we want to get out of some of the economic and financial mess we're in, that's the way to do it. So I consider those to be significant wins. Now, if we tally up the firm commitments, like Saudi Arabia is talking about $600 million investment, haven't firmly committed anything. Nissan and Honda have stated they're going to move plants from Mexico to the U.S. in response to the tariffs, but they haven't firmly committed anything specific. So if we look at just the specific commitments, what I tally roughly is somewhere around 1.4, 1.5 trillion and about 150,000 jobs. And that's in 3 months. That doesn't, 2.5 months. That doesn't suck. That's yay. Now, the tariff logic is really pretty simple. A lot of people try to make it complex, but it will jack up the cost of imports, and companies will build here instead. That's what we're seeing. Companies trying to avoid the tariffs. And some of them may not necessarily be as obsessed with the tariffs. Like if you're manufacturing in China, you have a pretty good bet that China's going to eat the cost of those tariffs. But if it's 6 one way, half a dozen the other, if it's kind of a break-even deal, then most manufacturers, I think, would prefer to be in the US because of government, because of the risk. The political risk are much lower in the US than they would be in China. So if the cheap labor cost is being moderated, the advantage of cheap labor is being moderated by these tariffs, I expect to see a lot more commitments. I expect to see commitments keep flowing. And there's not much China can do to stop it. They're losing business, they're losing dollars, and it's going to hurt their economy. They just can't afford to lose all of the dollars. So it's interesting times. It really is fascinating times in the economy and in the world. There will be some pain. I'm sitting here kind of presenting a optimistic picture of tariffs and the economy. There will be some pain and there'll be some industries possibly hurt by the tariffs imposed on US products that are being exported. But like last time, referring to 17, 18, I don't really expect those to last long because most countries simply can't afford to lose access to the US market or US aid. Like Canada, we import 5% of our GDP from Canada. Canada, we're 60% of their exports. They cannot lose that 60% in trying to penalize our 5%. There are countries like Greenland. Greenland's kind of an interesting scenario. In a poll a month ago, a majority of the people in Greenland, like 58%, indicated they favored joining the US. There was another poll 2 weeks ago where it showed a majority against, opposing joining the US. So which poll is correct? I don't know. There was like day and night, not even close. But the thing we do know for certain is Greenland just had an election and every party favored independence from Denmark. Some of them want it faster than others. That was kind of the separating equilibrium. So the party that favors, a steady independence won first with 30% of the vote. The party that favors a rapid independence received 25% of the vote. So the chances are really good that Greenland is going to move increasingly toward independence from Denmark. They don't think they've been treated well by Denmark. If they are moving further away from Denmark, then there's not many other places they can turn that have the capital resources to invest in Denmark and Greenland, and the ability to protect them from China, Russia, whoever they're concerned about. So they are united on leaving Denmark, and they'll likely have to form at least a closer relationship with the U.S. I really don't expect them to try to join us, but it'll be a very close relationship, both economically and probably militarily. So that's kind of, what I'm looking at on manufacturing and tariffs. Hope that, answered your question. Does that help? Anybody have any other questions? Don't don't hesitate to let me know. And E-Train, I won't quote her, but she is apparently having internet connection issues. So bless her heart. They have really struggled with that. Thought they had it worked out, but apparently something, it's still not worked. So hopefully she'll be able to join us here soon. Bless her heart. Got a bloody dog and no internet. How's that help? All right. We're going to just cover the economy. And I know some of this gets possibly a little bit less exciting than tariffs. What could be more exciting than tariffs? But hopefully this gives you information that helps you understand a little bit better what the most influential people in terms of the economy are thinking. I talk about the Federal Reserve often. And to me, interest rates are the single most important economic factor, macroeconomic factor. And so I pay a lot of attention to them. Of course, my background is in fixed income derivatives. It's important to me. And I believe it's probably the most sophisticated area of the market. Much, much more quantitative than stocks, equities. It's a better informed market, I guess is what I'm trying to say. So here, I've got a weird little chart. And, some people were talking about it last week when the Federal Reserve announced it was going to hold steady, keep its interest rate at, 4.25%, which was pretty much what the market expected. Now, they released a statement and all the market saw was, we're holding steady. Remember, inflation has been increasing for the past 3, 4, 5 months. And so there was some fear the Fed might actually hike again. So the Fed said, no, we're not going to hike. We're going to keep steady. And, it was a good day in the market that day. But if you read the Fed's whole report, their whole statement, which the market really is sucking at paying attention to details nowadays. Everybody's, going off the soundbite. But anyway, I digress. If you read their statement, they're getting a lot more hawkish, which means that they're getting more inclined to hiking rates, possibly hiking rates, particularly if inflation keeps increasing. The Fed did note increasing economic uncertainty. So they revised their predicted GDP down to 1.7 from 2.4%. No, 2.1%. So 1.7 down from 2.1, which is a pretty decent drop. And most importantly, it raised one of its inflation expectations to 2.8% from 2.5. So that's kind of like signaling we're still expecting inflation to increase. Moral of the story is we're holding rates level for now, but we may hike soon. So the dot plot, this weird little graph you see, it's called the Fed dot plot. And it's actually one of the more important graphs because it shows the expectations of each of the Fed governors for 2024, 2025, 2026, 2027. Each governor will vote on his projected interest rate for the Fed funds rate, which is their short-term rate. And here you see for the remainder of 2024, the Fed is pretty solidly ensconced at around 4.5%, 4.25 to 4.5, some a little higher. That's new. Now in 2025, for the average of 2025, the rate, they see the opportunity to drop the rate, have a rate cut, maybe 2 in the next year and a half. That's not great. Trump keeps saying he wants lower interest rates. I don't think that's exactly what he's dreaming of. And I'll admit, I kind of disagree with him on the lower interest rates. And I've even stated that with the amount of debt the Treasury's having to refinance this year, plus the new debt they're having to issue, it's huge. It's a massive amount. It's like 14 or 15 trillion dollars. When normally the demand is somewhere, the supply that the Fed will issue is somewhere around 3 or 4 trillion. So we're going to be having 4 or 5 times the issuance. That's going to impact rates. So I see rates holding up or even increasing, particularly as the Fed starts dumping all of these treasuries. The Fed is, still trying to indicate, still paying attention only to inflation and saying maybe over the next year and a half, inflation will moderate more and we can, start cutting rates a little bit. But when you hear people talking about the Fed dot plot, that's what this is the picture that they're talking about. Powell also indicated there's no rush to change policy. The Fed is still curious, quote unquote, or seeking clarity, is I think how he words it, on how Trump's policies, particularly the tariffs, is going to impact the economy. So the Fed is believing they are exercising caution. Inflation still is 75 to 100% above their 2% target, but they don't want to severely impact unemployment, which they predict to rise by the end of the year. So the Fed's in kind of a sticky spot. They can't control the Treasury issuance. And ultimately, they're really not going to be able to control interest rates. They've been the 800-pound gorilla for a decade, but the market may just overwhelm them. Now, initially, when the Fed released this report, the 10-year, which the 10-year is one of the most important rates because mortgages price off the 10-year Treasury. So if 10-year Treasury goes up, mortgage rates are going up. If 10-year Treasury yield goes down, mortgage rates are going down. Well, the day the Fed released this, rates dropped a little bit, but the last few days they've been increasing. They've gone from 4.24% to 4.33% today. So that's probably one of the most influential rates in your economic life that you can keep track of. Bottom line, the market's grappling with uncertainty. Market just doesn't know what the hell's going on, doesn't know which way to turn. On one hand, they're like happy the Fed's holding steady. On the other hand, they're like cautious because the Fed's holding steady. And you've seen it in the stock market movement. The stock market's up one day, it's down the next. Even during the day, it's up 200, 300, it's down 300. It's very choppy. And that normally is not necessarily a great sign. The market is becoming increasingly cautious. So as an investor, we want to monitor these kind of statements. We want to monitor the inflation rate, any changes. We want to look at policy developments closely and try to understand the increasing fears of stagflation, a stagnant economy and inflation. Think Jimmy Carter redo. Now, I argued we basically had a stagflation for the past year and a half in the private sector. Now, the government sector has kept GDP increasing, but I don't consider the government sector to be the real economy, especially when you're having to borrow 50% of what you spend. Taxes are $2.4 trillion a year. Spending is about $6 trillion a year. Total revenues are about $4 trillion a year. So, you've got fees and other duties, et cetera, that the government collects. Our expense on the interest right now is about $1.5 trillion a year. Last quarter, we spent $860 billion on interest. $860 billion. So if you do the quick math, that's $3.5 trillion in debt issued, not in interest, in debt issued. That's 3.5. We were borrowing at the rate of $3.5 trillion a year. Remember, the projected deficit for this year is $2 trillion. So it's going to be somewhere between 2 and 3 trillion, probably closer to 3. Just don't know yet. So you add 3 trillion to the 36 trillion we already owe, plus refinancing nearly a third of that at 1.5, 2 times the interest rate we had previously. You're looking at a pretty significant jump in interest expense, going from 1.5 trillion to 2.25 trillion. We'll be spending more in interest than we collect in taxes in a year or two, barring a miracle. In 2 years, think about it. We'll be borrowing money to pay interest. Now, what would your economic life and future be like if the interest on your credit cards was greater than your monthly income? That's where the federal government is headed. That's the problem. That's why it is so urgent that spending be cut and that some way to refinance the government debt that eases the interest expense will be found. That's why Trump wants lower rates. He knows what's coming. And he will, he's got to find a way to refinance the debt at a lower rate because Yellen left him a mess, a huge, huge mess. We'll see what happens. All right. I've seen some fun things over Tesla. Not gonna lie, I've seen some really bothersome things over Tesla too. The violence, the king of the cars, the firebombing, the stores, the assaults. Um, that's inexcusable. Those people need to be, punished and punished severely. But just looking at the stock peaked at 480 on December the 17th. Now it dropped nearly 50%. Let's be honest, volatility for Tesla is not new. That stock has continually, since its inception, it's been volatile. But, I think it's fair to attribute this drop to a lot of the irritation and anger at Musk, who owns 10 or 12% of Tesla. You know who owns the other 88 or 90%? You do. In your pension fund, in your mutual fund. So, for those people who are wanting to dump Tesla and sell it or hurt the company, burn the stores, if they have any retirement savings, they're hurting themselves. I love some sweet irony. Anyway, there are headwinds hitting Tesla, obviously. One of them's independent of Musk, just stagnant growth in the EV industry. Back-to-back years of no growth and declining margins. Tesla has had to cut prices 3 or 4 times in the past couple of years. Both Barclays and Bloomberg project softening deliveries, softening demand. People don't have the interest in EVs due to the expense, due to the cost of battery replacement, due to the risk of fires, also due to competition. China has produced some interesting competitors and produces them cheaper, eroding Tesla's global share. So that's one issue. Another issue is just simple valuation pressure. In late 2024, when Tesla was 480, that was 150 times earnings. 150 times earnings. A normal would be 22, 28, 30, somewhere around there. So Tesla was valued very highly. And the price is just simply compressing as the growth slows. You would expect that actually. Plus, there's economic uncertainty, Trump tariffs. That all adds risk. And then you've got Musk distractions. His stances, his activity with DOGE is earning a lot of ire among some of the population. And it's kind of amazing to me. SpaceX, some people may start striking out at SpaceX. Well, it was SpaceX that rescued the 3 astronauts or the 2 astronauts that were stuck for 8 months. And I don't know if y'all have seen the video on the female astronaut. She changed dramatically. I mean, even her bone structure changed. I hope and I pray there is no long-term issue with that. But SpaceX could have rescued them 8 months ago, 7 months ago. And the Biden administration refused because they were mad at Musk. Again, I find that kind of contemptible. But, SpaceX is just a miracle. Watching them catch the rocket booster and the big tweezers, that's amazing. So we'll see. But, Tesla, there was this poll in Financial Times, and 70% of the voters polled said that, yes, they would still buy a Tesla. 21% said Tesla's lost its appeal. 10%, I would have never bought one anyway. Honestly, I'm probably have been in the 10%. I looked at buying a Tesla, I don't know, 6, 7, 8 years ago, and they just didn't have the range. And, if I travel longer distances, stopping and recharging for half a day or however long it took, it was a long time. It just wasn't practical. It was really just better as a commuter car. Now, I understand they have improved some of that. I don't know all the details, but still kind of waiting till they get some of that improved. But there's something that I found kind of funny, and I only know how to label it as the Waltz effect. Tim Waltz, Kamala's well-known vice presidential candidate, was giving a speech on the 18th, and he said, quote, "Watching Tesla fall over the past 3 months boost his mood, makes him happy." And at the time, Tesla was $222. Remember, I said it had fallen about 50%? Well, there you go. That was pretty much near its low. Since then, every day, Tesla has been up. It's now up to $287. The Waltz effect. Is Tim Waltz better than Kramer? I don't know. But it's literally like once Waltz starts criticizing the stock, it's time to buy. I mean, it was just timed perfectly. So I don't know, but I thought that was kind of funny, the Waltz effect. Now, like I mentioned, there's some tailwinds for Tesla. And a tailwind is something that pushes it forward, helps it improve, adds value. Tesla is planning some new vehicle launches this year, more affordable models, which could boost volume. Part of the problem with Teslas is they've been relatively expensive. Tesla itself has a 23% delivery growth target. So that's a pretty strong target. They think they'll be able to hit it. We'll see. They've got some other advantages going for them. They're autonomous driving. They're far ahead of anybody else in autonomous driving and robo-taxi. That's kind of a wild card to me. Musk wants to deploy 1,000 robo-taxis by year end. Now, Musk, I have a lot of respect for Musk. I think he's a genius. I mean, he has done things that I wouldn't have imagined. A lot of people said are impossible. But if he has a fault, Musk is usually right in terms of trends and what he can do, but he consistently overestimates or underestimates the time to completion. He's almost always premature in his projections. So if he's thinking there's 1,000 robo-taxis they'll be able to put in service by the end of the year, I'm thinking they'll be lucky if they have, I don't know, 200, 300. We'll see. The cyber cab, quote unquote, slated for volume production in 26, could be very impactful if the prototypes work pretty good in 25. We'll see. There are some other tailwinds. The batteries in the Cybertruck, for example, they have some innovations which could offer significant improvements, which could also improve their margins. And one thing which has gotten very little play is Tesla is building a robot. I mean, a literal robot called Optimus. And he has a claim of building 5,000 of these robots in 2025, which, if he gets it done and is able to scale production, increase production accordingly, that could be a huge boost. A lot of people would think it cool to have a robot maid or a robot sidekick or a robot to cheer football games with them. I don't know what all the uses could be. If you have a manufacturing plant, if you're an Amazon warehouse, that robot can be programmed to know exactly where a product is, pick it up, take it, put it in a box, wrap, seal the box, put it on the line to the mailbox. That's just a repetitive task. They could be programmed for that. So you could see a lot of warehouses moving to robots. Could be a huge business for them. And then energy. Tesla is a leading innovator in terms of battery energy storage. And this segment hadn't been a huge segment for it, but it grew 50% year over year in the third quarter, 24. Analysts are expecting near a 20% growth in 2025. If they develop a new technology, if they are able to develop, for example, graphene batteries instead of lithium, huge improvement in safety and cost, bigger margins. So Tesla has some headwinds. It has some tailwinds. I think the tailwinds long term are going to be much stronger than the current headwinds. We'll see. Now, if you're looking at short term, some of the analyst reports, Cantor Fitzgerald upgraded Tesla to overweight, and they cited the self-driving vehicles and energy storage. RBC lowered its price target from $440 to $320. They basically were describing, tempered expectations of their software and robo-taxi deployment. Kind of what I was alluding to when I say Musk has been prone to premature timelines. And forecasts vary greatly. I mean, Tesla's in such unknown markets and it keeps pushing the boundaries in these markets. It's going to have some failures. It's going to have some successes. Coin price forecast predicts 332, which if you buy, right now it's at 286. So you're looking at a 20% gain for the rest of the year. The consensus, most of the estimates hover between 320, somewhere around 320, which was a 41% upside from the 228 6 days ago. But, it's risen $60. It was up $10 today. So, interesting. My analysis, bottom line, I think Tesla's core EV business may rebound modestly with the new models, but you're going to have more competition. You're going to have margin compression. You're going to have, with increased competition, it makes you have to sell for a tighter margin normally. On the upside, the robotaxi, the robot Optimus have high upside, but in 2025, they're bets. They're not a sure thing. With the Robo Optimist, I think the cost is going to be around 40,000 per robot. Tesla estimates they're going to be able to deliver 2 million of them over the next couple of years. That revenue would be about $120 billion. So if you assume that they can do that they reach that target, their earnings per share would grow to about a little over $3 a share, and their PE would normalize to 60, which is still high, but it's below the 73 of today. So the stock theoretically could reach 242. That's just a, back of the paper, quick estimates, kind of trusting Tesla's projections somewhat. So we'll see. But Optimus, to me, offers some of the greatest potential. It's a general purpose, is described by Musk as a general purpose humanoid robot. Handle dangerous, repetitive, or boring tasks. And if they're able to sell that for 39 grand a machine, there'll be a lot of takers. There'll be a lot of demand. Musk said Optimus will be able to do anything you can think of: cook, clean, factory work, even teach. Suppose you want a tutor for your kid to teach them in the classical literature. You can't find a human that's well versed in that hardly anymore. Tell the robot accesses AI, downloads a teaching program, boom. You have an expert tutor that can adjust the lesson plan every day depending on the ability of the student. Do you think that sounds interesting? We'll see. And in terms of Optimus, let me throw this out. Musk also believes that Optimus is the most important product Tesla's ever worked on. He thinks by 2032, let me back that up. No, he estimated in 2023 that it could be a $20 trillion market cap. It'll end labor shortages forever. So, particularly with demographics, so I've talked about demographics, somehow we're not having enough babies, how the population usually is pyramid shaped with more and more young people than old people at the top. But that's been reversed the last 20 or 30 years. It's extreme in China. That's why they're having such a hard time and will continue to have such a hard time. It's also hitting us here in the US, where we've got more old people than we do young. Historically, the problem with that is that young people produce, old people provide the wisdom. Young people provide for old people's retirement, either directly by taking care of their parents, for example, or indirectly by paying taxes that support them in their retirement. Well, if that pyramid is reversed upside down, you've got fewer and fewer young people paying for more and more older people. So you would expect taxes to increase. Obviously, the programs aren't going to be able to muster the votes to be cut because old people won't vote for that. So there's the math just doesn't work. There's a problem there. Well, the robots could greatly alter that labor structure, that productivity structure, because we're getting less and less productivity out of the younger generation, both in terms of just the raw numbers and in terms of their work ethic. It's not what it used to be. And that's a serious issue. Employers are having problems finding good Gen X employees. So Tesla. This is a post I saw the other day, and I don't know if you can see it. I'll read it to you. It says, ready to stick it to Elon and short Tesla? This is how you can make money from Tesla stock going down. 1, get a brokerage account, Robinhood, Webull, etc. 2, deposit as much as you can. 3, go to Tesla, buy a put, select June 20, 2025, $100 strike. Buy as many contracts as you can. They are $130 each. If Tesla's at $250 now and keeps going down, you're making loads of money straight from Elon's pocket where it hurts him the most. I was kind of shocked when I read this because some people are just encouraging stupid. I don't know of any other way to put it. These are deep, what we call out of the money puts. Now, a put, what's a put? You know, if you buy a stock and you own it and it goes up, you profit. But how do you profit when a stock goes down? Well, that process, you can, it's possible, you can short it. So the way that works is you borrow shares from somebody, your broker arranges it, you don't have to arrange it, and you sell those shares at the current price. The price drops. Then at the lower price, you buy them and pay back the shares you borrowed. So you're still buying low, selling high, but you're doing it in a reverse order. You know, the old adage is, stocks. I always want to buy low and sell high. That's how you make money. But you can do that in a reverse order. You can sell high, then buy low. So a put is an option that effectively does that. Well, you pay your money $130. So if you have $1,300, you'll do 10 contracts. The problem with the puts is that if you don't exercise them, and you have till June 20th to exercise them, if Tesla doesn't hit $100 by then, you lose everything. It's 100% loss. So I don't know if the guy posting this, I kind of think he posted it as a joke, but I actually saw some people implementing this strategy. And if, this was on, I think the 17th or 18th, it was right around Tim Waltz. And people went and did this. Well, if they did, they've probably already lost in 6 days. They probably already lost, I would say, 50% of their money. And I'd be willing to bet most of the people that did this didn't have the money to lose. Now, I don't, all my life in the market, I've basically taken money from stupid people. That's just the way it works. There are things that people do that they're begging you to take their money. And in some ways, I consider it a community service. I take the money and I put it to a higher and better use, taking care of my family, my responsibilities. But this is just insanely stupid. And to me, the moral of the story is, now this guy may just be throwing a sucker punch, but regardless, people are letting their emotions rule their investment choices. Letting their emotions rule their investment choices. Don't ever, never. If you're emotional about something, stay out of the market. Stay in cash. Do not allow your emotions to rule your investment choices or decisions. Emotions are bad. If you want to lose money, follow your emotions. If you want to get absolutely wrecked, follow your emotions. So, I see this. I just think of my second rule: stupid should hurt. Kind of the motto of the channel. Well, this is a perfect example of how people can be stupid in the market. And so, word to the wise: you may not be a fan of Elon, and maybe you want to stick it to Tesla. That's your call. But don't do it because of your emotion. Look at Tesla, look at the stock, say, do I really believe that this stock is going down? Then you can short it. Shorting is risky. Buying puts, options are risky, have higher risk. So if you don't understand the risk, if you don't understand actually how it works, don't do it. If you don't understand where you're investing your money, don't do it. Simply don't do it. If you've got some questions you want me to explain this process more, I'll be glad to go into more detail. But I'm trying to keep it kind of Cliff Notes version so I don't beat you over the head with boring. Now, too bad E-Train's here. I mentioned earlier that I was going to talk about boomers. Being a boomer. And boomers are absolutely rocking it. I saw this graph, intergenerational wealth, and it's the share of national wealth owned by each generation by median cohort age. Now, that sounds kind of technical, but here's 20-year-olds, here's 30-year-olds, 40-year-olds, 50-year-olds, 60-year-olds. And if you look at this graph, it seems like baby boomers are owning everything, which we are. You may be inclined to look at this and say, well, we'll never reach that. They're stealing it all. No. Most generations have more wealth as they get older. Now, one kind of deceptive thing here is like for boomers, this graph cuts off at 1990 for boomers, which they would be on average 35 years old. If you took this graph on down to where they were 20 years old, they started off with less than the millennials and Gen Xers. So people go, Gen Xers or millennials, Gen Zers, we'll never have that much wealth. We'll never be able to buy our house. Well, I asked my class, one of my classes this past week, would you like to live a 1950s middle class lifestyle? You've got two-parent household, one of them works, one of them stays at home, 2 kids, you've got a house, car, you're able to save enough to pay for the kids' college. And most of the kids in the class raise their hand and go, yeah, that would be a good life. And then I ask, how many of you think you'll be able to obtain that? Not a single one of them raised their hand. And I said, you can obtain it. It is very, very possible to do that today. I said, but a couple things have to change. One, you'll only own one car, and it'll be kind of a base car, probably an older model, but you'll only have one car. Your house will be 1,000 square feet or less. You'll have small bedrooms. You'll have a small kitchen. You'll have small baths, small closets. Your kitchen, your appliances will be very basic. Now, if you could go back to the 50s and buy their appliance, they would last you 50 years. So that's an advantage, but you would buy very basic appliances. You may not even have a washer and dryer. or you may only have one of them. In addition, vacations you would take to places within a few hours drive. Everybody would load up the car and you would drive to your vacation spot. Very, very little, if any, air travel. No air travel for most people. If you're willing to simplify your life, live simply, you can have that 1950s middle class lifestyle and live it on about $38,000 a year, which is extremely obtainable. You know, you won't be able to go to Starbucks every day and get that $8 coffee. Think about it. If you spend $8 a day, 5 days a week, that's over $2,000 a year just in coffee. What could you do otherwise with $2,000? This kind of wealth, this kind of savings is obtainable. But you've got to start saving. You've got to live simpler when you're younger and not try to buy the nice, big apartment, not try to buy the nicest clothes, not try to buy, have the fanciest car, fanciest furniture, not take, expensive trips everywhere. Now, if you want, I love trips. I love traveling different parts of the world. Sometimes I'd rather have the memory than the money. So I'm not saying that's wrong. I'm just saying if you want to accumulate wealth, you've got a good opportunity, but you have to live simpler. And that's something that a lot of Gen Zers, a lot of millennials maybe have a problem doing because consumption. I mean, how many of you have a $1,000 phone? That was impossible back in the 50s. You had a landline. How much do you spend for a phone every year, including the cost of your phone? For years, I carried my daughter's phone or, friends, maybe, some of the girls I was close with, and I would spend $300-$400 a month on average on phones. What if I just had a landline and didn't have the cell phone? You get the idea. Generational issues. Another big difference in the wealth accumulation that most young people don't understand. And, I don't want to go to preaching, but this is a serious economic consideration. Marriage is a wealth amplifier. You benefit, first of all, from dual incomes, shared expenses. You've only got one house payment or rent payment. You benefit from economies of scale. As a single individual, it's more expensive for me to eat per person. I may tend to eat out more. I may tend to have more waste because the meals I cook, maybe I don't eat it all and I have leftovers, and I accumulate leftovers, and then after a week or whatever, I've got to throw them out. A 2021 study from the Federal Reserve found that married couples had a median net worth of $251,000 compared to $63,000 for single individuals, even after controlling for age and education. So same age, same education. If you're married, you're going to have 4 times the wealth of a single person. And that gap grows over time. GAO pointed out that married couples accumulate more retirement savings. There's surveys of consumer finances. Married couples over 45 have more than double, at 45, have double the assets of never married peers. Now, I'm not saying go out and get married so you can be wealthier, but there is a practical reality to marriage. And it's something that as the younger generations participate in less and less or get divorced more and more, that's a cost that subtracts from greatly from your ability to accumulate wealth. And I say that as a single dude. So trust me, I understand. Um, Staying married, it's a huge advantage. Divorce will split assets, it disrupts savings, it incurs legal costs, significant, oftentimes, legal cost. Um, a study by the American Sociological Review found shows that divorce reduces household wealth by 20% on average, with women experiencing a steeper drop up to 30%. Alimony, child support further strains finances. Conversely, if you stay married, it allows for long-term compound growth of this money. And remember the miracle of compounding, I've talked about it several times. It's not just the growth in the early years, it's really the growth in the later years that turns exponential, that interest on interest effect that occurs after 20, 30 years. That's when you get the huge increases in your wealth. The equity in your home. If you're having to sell homes every 10 years because you get divorced again, you're never going to accumulate equity. Far, far harder. Boomers had much higher marriage rates, around 90%, and far lower divorce rates. So if you want to know why boomers accumulate so much more wealth, particularly as they get older, that's why. That's a huge, huge factor why that most people ignore. Millennials aren't getting married till median age of 30 or 32. And less often, their marriage rate is down to about 60% by age 40. And you've got a much higher divorce rate. So that delayed marriage can mean less wealth accumulated over time. Just that's the way it is. So now marriage, don't get me wrong, marriage doesn't guarantee wealth. High earning singles can outpace low earning couples. It's just the math. Toxic marriages can drain resources emotionally and financially. So, marriage, avoiding divorce can be important for wealth accumulation, is my point. Data backs up the advantage. So when you look at somebody talking about boomers have more wealth than maybe I'll ever be able to accumulate, there's reasons why. And it's not because boomers stole everything. Marriage is a multiplier. It's not a magic bullet. It's not a magic cure, but it is significant, very significant. And, if you want to be real, let's face it, the Gen Zers, odds are stacked against y'all's. Odds are stacked against y'all. I mean, as a boomer, we never were required to start our day with an $8 cup of coffee. We didn't need designer clothes. So odds are stacked against y'all. Also, let's keep in mind, the apartments and first houses we had were smaller and far less comfortable than what you have to live in. We had to work during our teen years. Every summer from the time I was 10 and on, I had to find a job. Now at 10, 11, 12, I couldn't get a permit to work for a company. My dad owned a manufacturing company, a mattress manufacturing company. And that's where I'd work. So during the summer, he had a felt machine. Now, a felt machine, you take a bale of hay and put it in this chopper, and it chops it up into fine little pieces and feeds it and then strings it out and lays it on a felt. And this felt is then collected on a roll, which can then be rolled out on mattress. As you can imagine, there's a lot of dust, cotton dust that accumulates. And so my job during the summer, and this machine was 50 yards long. My job in the summer would be to crawl underneath that machine when it was 105 degrees outside. You were in the back, very poor ventilated, tons of dust, and clean out all that accumulated dust from under that machine, bit by bit by bit. That was my job at the summer as an 11-year-old. When I finished that, then I'd be working in the back making mattresses or help, tear old ones apart, see if the springs were salvageable. There also was a upholstery department. So I kind of learned how to upholster. And there were a couple times where I shot a nail through my finger. And so I remember the first time I did, I was sitting there looking at it. One of the other guys sit there, put my hand down, put his foot on it, took a pair of pliers and just pulled it out. That's how you handled it. Put a Band-Aid on it and go back to work. So, yes, as a boomer, I've had tons of advantages over Gen Zers. And I actually had to save money. Couldn't spend it all. Dad made me save it. Damn him. And I love him for it. Anybody have any questions so far? I've been talking. Anybody have any questions? Is this making sense? I hope so. I already talked about, keys to wealth, being married. This is another graph that shows the percentage of Americans married by birth decade. I don't know if you can see the numbers. Many of you are on your cell phone or something, but the top line's 1940s, the 1950s, 1960s. Then you have 1970s. And you can tell these 4 decades are all pretty, they're above 80%, some of them above 90%, but all of them very, very high marriage rates. Well, for people born in the 80s, the marriage rate drops to 65%. For those born in the 90s, the marriage rate is around 35%. So, and they're waiting longer. Young people are waiting longer to get married. So, financially, economically, if you're going to get married, the sooner the better. You'll be better off if you pick well and don't get a divorce, if you choose well. And that's really a big key. I'm not going to get into marriage consulting and tell you how to pick well. I'm probably not the guy for that. Gold has gotten a ton of attention over the past 6 months. But I saw this and I thought it was interesting. I saw this, and this is the first one I've seen, but maybe it has some merit. It's a contrarian view on gold. It's Morningstar's analysis. Their chief analyst, David Sekera, presents a contrarian perspective, I guess I want to call it, on gold's long-term price trajectory. And he put this out on March 19th. He basically forecast that gold would decline to about $1,800 within the next 4 or 5 years. That's a pretty strong contrast to both the recent performance and current projections. Now, gold reached a high of $3,057 on March the 19th. Since then, it's kind of tread water or dropped a little bit. And, it's largely been propelled by the expectations of greater risk in the U.S. economy and inflation. But Morningstar's analysis here, Sekura's analysis of the future of gold, he took into consideration supply and demand dynamics, looked at the, prospects for future supply, factoring in extraction cost, mining cost over the next 5 years. And he makes a good argument in the article that the conditions historically driving gold prices upward, such as negative real interest rates, are weakening. If you look at real interest rates after adjustments for inflation, they're positive. They're not negative. That traditionally exerts downward pressure on gold. Demand side, the cure for high prices is high prices is an old cliche, an old adage. Elevated prices lead to more supply. People are, selling more of their gold, and it ultimately destroys demand. Fewer and fewer people can afford it. So with maybe 50% of the gold produced being used for jewelry, there probably, as the gold price increases, there'll be more of a substitution effect. That's a damn good point. People will opt for cheaper alternatives or lower blends of gold. Instead of 24 karat, use 18, or instead of 18, you use 12, whatever. Additionally, you've got about 10 or 15% of the gold supply being used in industrial applications. And as gold price has risen, you probably will see manufacturers shifting to cost-saving substitutes, further reducing demand. Those are good points. Now, this process may take a couple of years to materialize. But you've also got the fact that the higher price will incentivize new mining. So that's another thing that will increase supply, lower the price. Now, that also will take some time, but you look at all these different factors and the analysis, he's got some points. So it's an article worth reading if you can find it. If you're interested or thinking about buying gold and holding it long term, you might want to consider that article. His analysis, kind of hinges on a combination of waning demand. Price gets higher, people will buy less of it. The historic relationship with real interest rates, substitution effects, and increased supply from new mining. Admittedly, gold has enjoyed quite a rally the past 6 months. It's up 16% in 2025 so far. But, some of these are fundamental shifts which you really shouldn't ignore and will ultimately reverse its trajectory. Nothing goes up forever. So I thought that was interesting and thought I would throw that out. Now, just about out of time, but I have one more issue I want to rant about. And this is just simply to the parents or people who will be parents or people who are grandparents. And, I've seen this over the years in class. Kids increasingly have more and more cognitive, more and more reasoning challenges. They are less and less able to engage in reasoning. They have difficulty concentrating. This means they have trouble learning new things. And here's a graph showing the, percentage of kids going from 1990. You see it kind of slowly increasing through, 2012. But since then, you have seen a marked increase, a huge shift in the number of kids reporting to have difficulty concentrating. Same thing with trouble learning new things. And if you look at this is turning exponential. It's going to increase at a faster and faster rate as kids get older. This is 18-year-olds. And this was done a year, 2 years ago. So just wait till those kids that are 15, 14, 13 reach 18. These numbers are just going higher. If you have kids, if you are around kids, understand that the easier you make their life, the worse you make their life. The less intellectual challenges and stimulation you give them, the worse you're making their life. Get them off their damn phone. Get them away from the damn TV. Get them to read books, classic works through the years. Help them to fundamentally understand basic math. Ignore the new math. I don't care what the teachers say. What they do a horrible job teaching arithmetic, basic algebra. And some people go, math, I won't use it. But the problem that I have with that is that math teaches you how to think. It trains your mind in rational processes. And so if you don't have your kids focusing on math, you're basically encouraging them not to develop the ability to think. You're hurting your kids. You're hurting your grandkids. Now, my time in the teaching world is about up. So I really have nothing to gain here. And you can look at the numbers and the data yourself. So just ask yourself, do kids deserve better? If they do, why aren't you out there demanding it in your school, in your educational system, in your home life, in your time with the kids? Why aren't you out there demanding it? So that's the end of the rant for tonight. I'm also out of time. We've reached the 9 o'clock hour. I want to thank you all for your patience, for your support of the channel. We do appreciate. Would ask before you leave if you would hit that like button. If you're not subscribed, then please subscribe. Both of those help us out. Just click on the like button. And we'll be back Saturday night. If you have some other questions, comments, or whatever, email me, moffatonmoney@gmail.com, or DM me on Twitter, moffatonmoney, on X, as it is known now. I still call it Twitter. But thank y'all. Appreciate y'all being with me. Good to see members of the family. And look forward to seeing you Saturday night, 7 o'clock, same time, same station. Y'all have a good rest of the week. Our time is up. We thank you for yours. Good night.